Welcome students. Today I am going to discuss Unit 1 of Financial Derivatives and my topic is derivatives. Introduction to the derivatives. Let us discuss first the meaning of derivatives. A derivative security is the financial contract whose value is derived from the value of something else, such as a stock price, a commodity price, an exchange rate, an interest rate, or even an index of the prices. Derivative does not have its own value. Its value is derived from the underlying asset. We can say derivative refers to the security or to the contract that derive from another whose values depend on another contract or asset. As such, the financial derivatives are the financial instrument whose price or the values are derived from the price of other underlying financial instruments or financial assets. The underlying instruments may be an equity share, a stock, a debenture, a bond, a treasury bill, a foreign currency, or even another derivative asset. For example, a stock options value that depends upon the value of the stock on which the option is written. Similarly, the value of the treasury bills or future contracts or a foreign currency forward contracts will depend upon the price or the value of the underlying assets such as the treasury bills or a foreign currency. In other words, the price of the derivative is not arbitrary, rather it is linked or affected to the price of underlying asset that will automatically affect the price of the financial derivative. In the simple words, we can say that the price of the derivative depends upon the underlying assets, just like the price of the curds depend upon the price of the milk. If there is increase in the price of the milk, the price of the curd is also increased. In the 1980s, the financial derivatives were also known as off-balance sheet instrument because no assets or liability underlying the contract was put on the balance sheet as such, since the value of such derivatives depends upon the movement of the market price of the underlying asset. They were treated as a contingent assets or the liabilities, and such transactions and positions in the derivatives were not recorded on the balance sheet. In brief, we can say that derivatives are the financial instrument whose payoffs are derived from other more important financial variables, for example, a stock price, a commodity price, or an exchange rate. It can be said that it does not have its own value. Its value depends upon the underlying instruments to which they represent. Now let us discuss about the economic functions of the derivative market. The derivative market performs a number of economic functions. The first one is the detection of the price. Price in an organized derivative market reflect the perception of the market participant about the future and lead the price of the underlying to perceive future level. Derivatives serve as a barometer of the future trends in the price, which result in the discovery of the new price both on the spot and the future market. Further, they help in disseminating the different information regarding the future markets, trading of the various commodities, and securities to the society which unable to discover or form a suitable or a correct or true equilibrium price in the market. As a result, they assist in accurate and the superior allocation of resources in the society. The price of the derivative covers with the price of the underlying or the expiration of the derivative contract. It shows that it's helping discovery of the future as well as the current price. The next point is transfer of the risk. The derivative markets have to transfer the risk from those who have them but do not like them to those who have an appetite for them. It means derivative market is helpful in transferring the risk from those who want to take the risk and those who want to hedge the risk. They are not interested to take the risk. Derivative assist the holder to shift or modify suitably the risk matrices of their portfolios. These are specifically useful in high volatile financial market conditions like erratic trading, high flexible interest rate, volatile exchange rates, and the monetary problems. Next one is the liquidity and the volume of trading. Derivatives, due to their inherited nature, are linked to the underlying cash market, means a spot market. With the introduction of the derivative, the underlying market witnessed a high trading volumes. This is because of the participants by more players who would not otherwise participate for the lack of an arrangement to transfer the risk. The derivative assists the investors, traders, and managers of large pool of funds to devise such strategies so that they can make the proper asset allocation, which is going to increase their yield and achieve other investment goals. Moreover, it has been observed that from the derivative trading in the market that the derivatives have smoothened out the price fluctuation, squeeze the price spread, integrate the price structure at different points of time, and remove guilds and the shortage in the market. However, the derivative market helps to develop the market towards a complete market. Complete market concept refers to that situation where no particular investor is better than other or patterns of return of all the additional securities are spent by already existing securities in it, or there is no further scope of additional securities. Derivative market also encourage the participating more people to participate in the market, and it's act as a catalyst of the new entrepreneurial activity. The derivative has a history of attracting many bright, creative, well-educated people with an entrepreneurial attitude. They they often energize others to create a new business, new products, and new employment opportunity, the benefit of which are immense. In the nutshell, we can say derivative market is a market which helps increase the savings and investments in the long run. Transfer of the risk, no doubt, enables a market participant to expand their volume of activity. Now let us discuss the different participants in the derivative market. There are the three participants: hedgers, speculators, and arbitrators. The hedgers are the investors with the present or the anticipated exposure to the underlying asset in which is subject to price risk. Actually, hedgers use the derivative market for the price risk management of the assets and the portfolios. They are going to hedge their risk. An example is given. An importer has to pay a USA dollar to buy goods and rupees is expected to fall to $50 from 48 per dollar. Then importer can minimize his losses by buying a currency future at 49 rupees per dollar. Then there is a speculator who wants to take the risk. These are the individuals who take a view on the future direction of the market. They take a view whether the price would rise or fall in the future and take a position accordingly. They are going to sell the buy or sell the futures and the option to try and make a profit from the future price movements of the underlying asset. Let us take an example. If you will, the stock price of Reliance is expected to go up 400 in a 1 month. Then what one can do? They can go for the 1 month future of the Reliance at a price of 350 and make a profit. But never do the trading without mentioning the stop loss. If they have entered into the contract of the future at the price of the 350, then they have to put some stop loss amount, stop loss in which they are going to exist from the market. It may be 330 or 340. And the lot size of the Reliance company share is 250 per lot. Then there is the arbitrators. These are the third important participants in the derivative market. Actually, they are entered into the market to earn a riskless profit. The arbitrators take a short and a long position in the same or the different contracts at the same time to create a position which can generate a riskless profit. Now let us discuss the different types of derivatives market. The first one is the exchange traded derivatives. Derivatives that are traded on the exchange are called the exchange traded derivatives. These are traded on the recognized exchange. These contracts are standardized in the terms of the quantity, quality of asset, maturity. Such standards are decided by the concerned exchange, not by the individual. These contracts are offset or delivered on the specified date as per the exchange notification. These contracts are settled through recognized clearinghouse of the exchange. Such clearinghouse perform as a central counterparty for each contract. Moreover, the margins are required in these contracts, which are to be paid by the parties to their members of the exchange. The margin is also decided by the exchange. The mark-to-mark system is followed in these contracts. Daily settlement features set the value of these contracts at a zero at each trading day. These contracts are done through the members of the exchange. Hence, there is the involvement of the brokerage fee for the buy and sell orders. These contracts are settled through the clearinghouse. There is no risk of setting the contract at the maturity date. The next one is the forwards. A forward is a customized contract between two parties where settlement takes place on a specified date in the future at today's pre-agreed price. Forward contracts are bilateral contracts, hence they are exposed to counterparty risk. There is a risk of non-performance of obligation either of the parties, so these are riskier than the future contract. All the forward contract is custom designed and hence is unique in the terms of the contract size, expiration date, the asset type, or the quality. In the forward contracts, one of the parties takes a long position by agreeing to buy the asset at a certain specified future date. The other party assumes a short position by agreeing to sell the same asset at the same date for the same specified price. A party with no obligation of setting the forward contract is said to have an open position. In the forward contract, derivative assets can often be contracted from the combination of underlying assets. In the forward market, the contract has to be settled by the delivery of the assets on the expiration date. In case the party wish to reverse a contract, it has to compulsory go to the same. The next one is the futures. A future contract is just like a forward contract, but there is a difference between the futures and the forward is that the forward is done through the OTC over the counter, but the future contracts are done through thoroughly exchange. A future contract is an agreement between two parties to buy or sell a specified quantity of an asset at a specified price and at a specified time and a place. Future contracts are normally traded on the exchange, which set the certain standardized norms for trading in the future contract. The participants in the future market follow the norms set by the respective exchange and are required to post margin, which is essentially collateral against the default of the participants. The next one is the interest rate swaps. An agreement between two parties which is known as a counterparty, which is one is going to buy the contract and the other one is going to sell the contract, where one stream of the future interest payment is exchanged for another based on a specified principal amount, and this principal amount is a notional amount. There is no exchange of the principal amount, but there is exchange or the swap of the interest rate only. Options. An option represents the right, but it's not an obligation on the part of the buyer to execute the option. They can buy or sell a security or other asset during a given time for the specified price, which is known as the strike price. Options are the most important group of the derivative securities, and I have already explained that these are the contracts between two parties where one party obtained the right but not an the obligation to buy or sell a particular asset at a specified price on or before a specified date. The person who acquires the right is known as an option buyer or an option holder, while the other person is known as the option seller or an option writer. The seller of the option for giving such option to the buyer charges an amount which is known as the option premium. And there are the two types of option. One is a call option and the second one is a put option. In the case of the call option, it is going to buy when the market is showing the bullish trend and the holder has the right to buy an asset at a specified date or a specified price. Whereas in the put option, the holder again gets the right to sell an asset at a specified price and the time. The put is going to be buy when the market is showing the bearish trend. Now the next derivative is the OTC contract, which are privately negotiated derivative contract. This can be known by another name, that is over the counter, and these are traded over the counter of the respective parties directly. These contracts are made on the basis of the requirements of the parties. Terms and the conditions of the contracts are decided by the parties themselves. Moreover, the delivery date of these contracts are settled by the parties themselves. These contracts are settled by the parties by themselves. No third party is involved in this process, and these contracts are also called self-regulated contracts. Why these contracts are called self-regulated contracts? Because there is no involvement of the exchange. There is no need to give the margin as it's required in the case of the exchange traded. Moreover, these contracts are settled on the maturity date and not before that date unless both the parties are agrees for the for the transfer or the prepayment of the contract. Moreover, there is a credit risk for the each party. These contracts are the riskier in nature. Credit risk is more in these contracts. Credit limits must be fixed for each parties. Thank you very much.